Welcome back to Win with Econ, macroeconomic strategies for investing. In today's investor series clip, we'll go over one of the quickest ideas out there. It's a take on the developing market strategy. This is a more intense version that's going to net you better returns in the long term. It's not meant for short term, but this video should only take a couple minutes. Please feel free to leave any questions you may have. Very basic strategy. This is the credit versus GDP strategy. It bets on the fact that financial systems will advance in countries with higher GDP growth than that of developed countries. So essentially what you're doing is you're betting on developing markets not only growing, but you're going to specify that you're going to invest in certain sectors, in this case the financials, that will boost at probably the highest rate than any other sector within a developing country. We'll just go over a quick example on how financials compare to that of a developing country versus developed, so you can kind of reflect on understanding what's important in this strategy. So the strategy is focusing on the credit system, right? So it plays a role, it buys into the fact that as a country evolves and advances financial system, a lot of new financial services will emerge that benefit by taking a cut after every single transaction. This includes, as workers develop, they're going to need insurance and life insurance plans, transactional and mobile payments that come as the country becomes more technologically advanced, as more home ownership increases within said countries. The rise of mortgage and credit services also accommodate this. So a simple example of this is India versus the US. India is one of the fastest growing countries as it has the most room to grow depending on what rates and metrics you use compared to purchasing power parity. The US, on the other hand, grows at a rate about 2% GDP growth, which is fine. It's a developed country. It shouldn't be growing as fast. And in this example, we'll go over what I feel are the most comparable stocks for said sectors. So when we compare HDB, which is India's largest financial service bank, it's grown by 40x since the 2000 year. JP Morgan, on the other hand, has grown by 5x, and this makes sense, right? What India is capitalizing on is not that just that a 6% growth compared to 2% is that it will increase by 3 times the rate. You're betting on the fact that financial services always take a cut within said growth, right? Who's lending these businesses money in the first place? Who's giving that consumer the loan that they need to buy their own home? Or who's helping with the transactional services behind this company's banking products? So we look at HDB, which is the largest bank. They play a role in virtually everything, from investments to home ownership themselves. As a result, they've reaped the rewards of that, which is that in their 20-year growth, they've experienced a 40x return compared to that of JP Morgan. When it comes to mortgages, this might be a little bit unfair as home ownership in India has been significantly low before the 90s. And on the other hand, the US has suffered a housing crisis in the last 10 years. But if you look over the 20-year span, it still seems to be unfathomable that a company such as HDFC is able to grow by 65x. That would be a great investment even if it was a 30 or 40-year plan, and this is a stock that's gone up by 65x within that short period of time. And of course, we should talk about this final example, which is what Axis Private Banking plays. Even though I included insurances below, I wanted to kind of close this video by talking about Axis. Axis is kind of the Goldman Sachs of India in terms of they focus on improving the wealth of high net worth client individuals. And as you can imagine, the American equivalent would be how much more wealth inequality has grown as a result of a rising stock market, right? It only affects X individuals, maybe a top 10%, 1%. I don't want to get too political, but the point is, Axis is able to tap into this role of offering financial services to these high net worth individuals, but more importantly, giving an investment opportunity for many people. So, in closing, India may not always maintain this high rate, again, as they are a developing country. They may reach their development sooner than others. I would wish most people would actually do their own research and understand what countries for the next 20 to 30 years are projected to have the highest GDP growth, and find out what is which banking stocks are the most privatized, meaning that the government's going to allow foreign investors to be a part of this. So Vietnam, for example, is not very privatized for global investors. Their banks are off limits for those who are not Vietnamese citizens. But a good example would be finding Ethiopia, Nigeria. These countries have close to 8% GDP growth. What banks can we tap in there, or what financial services can we tap in that are going to have a monopolistic view on these stocks, but at the same time produce massive growth? Always think of this strategy as if you're investing in a small cap stock, right? You're not always investing in a small cap stock because you feel that they have the breakthrough idea or they have this incumbent advantage. You're investing in them because they have the highest multiple to them, despite the risk. What makes this more beneficial is that since the dawn of time, every country has done everything it can to grow, and unless you expect governmental revolution for said developing country, that would be a sound investment rather than investing in the financial services of a high GDP, low growth country. Thanks for watching.